So I did a lot of these videos on YouTube about mistakes that stock market investors tend to make, and even mistakes that I made valuing stocks and doing other things in the market. But this is, I believe, the biggest ever valuation mistake that most stock market investors tend to make. I tend to see them making them on YouTube. This is why you had a lot of people, kind of down 50, 60, 70, 80% on a lot of stocks in 2022. They most likely overpaid, and they overpaid for one single reason. And this is what I'm gonna try to share in this video. This is a trick that actually helped me avoid drawdowns. I mean, maybe every 2 to 3 years for me to have a stock down more than 20%. Most of the drawdowns I have are like 4%, 5%, 7%. And this is for very good reasons. And it's because of the trick that I'm gonna actually talk about and show you in this video of how I'm actually, doing it. And I even implemented in my valuation models on YouTube. But most of you actually don't realize why I'm doing this. And most of you don't ask me, why don't you, do something else? Why are you doing this specific, valuation method? So I'm gonna share all of that in today's videos. And if you enjoy it, please press the like button and maybe consider subscribing if you're new to the channel. So the single biggest investment mistake, valuation mistake, that stock market investors tend to make, and this is valuing a stock over the next 10 years instead of 5 years. And it might sound very simple, but if you look at a lot of videos on YouTube and maybe yourself or other people, they always value a stock over the next 10 years. They say, for example, Palantir is trading at $10 per share. In 10 years, Palantir is going to be at $200 per share, or in 15 years, it's going to be $400 per share or $500 per share. And this is a very big mistake. And if you've been watching my YouTube videos, you know that I only value stocks over the next 5 years, and I tend to only look for doubles. And if I can't double my money over the next 5 years, then I'm not going to buy this company. And this is for 3 main reasons, and the third one is the most important one. So you might stick around to actually know the reason and the tricks that I actually use. But the first reason why I don't value stocks over the next 10 years is because we're having a pretty rapidly changing world. I mean, if you think about it, like what happened with TikTok, it just came out of nowhere. It took market share from Meta. Yes, Meta is still an amazing company, but you could see how TikTok just came out of nowhere, and how OpenAI and Microsoft came along, and how all these things are actually happening. I mean, unless I own a mega cap kind of stock, and maybe Berkshire Hathaway or something like, Microsoft or something, then maybe I can use a valuation model for the next 10 years. But maybe Palantir is not going to be valuable 10 years from now. I mean, maybe someone else is going to come along. Maybe, something like Google. Maybe Google is not going to be the search engine that's going to be valuable 10 years from now. I'm not saying Google is a bad company, but you have to think about that stuff, that 10 years from now, there's a lot of things that could change. And if you believe that for certain that, for example, Google is going to be the dominant search engine, is going to have the same moat that it has 10 years from now, then I believe you're actually fooling yourself. Even 5 years from now, we're going to have a lot of changes with AI and with a lot of things that happen. So it's very hard to tell even 5 years from now, not even 10 years. 10 years is a long time for me, or even 15 years. I don't do any valuation models over the next 10 to 15 years because there's a lot of things that could change. There's a lot of unexpected competitions that could come along. I can still somehow see a clearer picture over the next 3 to 5 years than over the next 10 to 15 years. And this is the first reason I don't do it. The second reason why I don't really do it is because it's very hard to determine interest rates. And whenever you're doing a valuation model, you have to somewhat be able to tell what kind of level or what kind of range interest rates are going to be whenever you're assigning, this multiple, especially the way I do it in my, valuation model. And over the next 3 to 5 years, I can somewhat tell some kind of a range where interest rates are going to be. But over the next 10 years, it's extremely hard to tell what's going to happen in the world, if inflation comes back or not. I mean, it could come back next year. But over the next 3 to 5 years, you could somehow tell a clearer picture of what's going to happen. You could at least use whatever the Fed is saying they are planning of doing over the next 2 to 3 years. But even the Fed doesn't look at 10 years from now, because this is very far in the future. and a lot of things can actually happen. But this is the last one, and this is, the highlight of the video and the main reason why I don't value stocks over the next 10 years. And this is the main reason why this is the biggest mistake, valuation mistake that stock market investors tend to make. And this is because it leaves a large margin for overpaying. Let's say you look at Palantir in 2021 or in 2022, and it's trading at something like $20 per share. And you do your valuation model, and you say, for example, Palantir is going to be a $200 per share company 10 years from now, in 2033 or in 2035 or something, $200 per share. Now, that would leave you for a very large margin of overpaying. For example, you would start telling yourself, and you hear it a lot on YouTube, some people on YouTube claim that it doesn't matter if you buy Palantir at $25 per share, at $15 per share, or at $10 per share, or $25. It doesn't matter what you buy Palantir at, because Palantir is going to be a $200 per share company in 2035. Well, what if this doesn't happen? Then you really overpaid if you were buying Palantir at 25 instead of 20, or if you were buying it at 30 instead of 20 because you have the $200 number in your mind. What if a new competition comes along? What if we have much higher interest rates? Palantir is going to be very affected. So no one knows what's going to happen 10 years from now. And if you look at a lot of these valuation models and you see a stock for $10 per share, you think it's going to be worth something like $30 per share, something like 2035. This leaves you with a very large margin for actually overpaying. Now, the way I do it in my portfolio and in my valuation models here on YouTube, I stick for doubles every 5 years. And this is my standard. So if I see Palantir at $20 per share and I see Palantir is worth at $40 per share, I know I can only pay 20. I can't pay 21. I can't pay 22. I can't pay 25. I have to buy Palantir at $20 or below if I want to double my money over the next 3 to 5 years. This is how I personally do it. And if I buy Palantir at 15 instead of 20, then I actually have a margin of safety in case I was wrong on the $40 per share. And after I get my double 3 to 5 years from now, then I can decide if I want to keep it as a long-term investment or not. But first, I want to kind of guarantee myself some kind of a return, and I want to make sure that I'm not actually overpaying. And this actually screens out over 95% of the stocks, because most stocks are actually a buy 10 years from now. And this is the kind of mindset you get into as an investor. You buy some kind of a stock, it goes down 50 or 60%, then you start telling yourself, oh, but this is for the long term, I'm only a long-term investor. Maybe you are actually a long-term investor, but you start telling those things to yourself to actually feel better, even though you actually overpaid for the company. And the problem is that you actually never learn why you overpaid or why you're down 50 or 70%, so you go and repeat the same mistake again and again and again. I mean, any investment is a buy 10 years from now. Any investment is going to do well 10 years from now. Even just dividends is going to do well 10 years from now. But it's all about doing well on a relative basis and on a risk-adjusted return. And if you're buying Palantir at $20 because you think it's going to be worth $200, well, maybe you're wrong on the $200. Maybe it's only worth something like $30 or $35. Maybe something unexpected comes along. And in this way, you actually made a mediocre return compared to the S&P 500. But the way I do it, I stick with doubles every 5 years, and this would give me around a 15 to 16% annual return, which is much higher than the average of 8 to 10% for the S&P 500. So if I get the 15% return, it could be a little bit higher, a little bit lower, but around 15%, then I can decide if I want to keep it for the future or not. But first, I want to kind of guarantee some kind of a return that's going to be above the S&P 500, and then I can make this decision if I want to hold it for the long term or not. But this is really, I believe, why most people have huge drawdowns in a lot of the stocks, down 50, 60, 70%. It's because they overpaid. And the reason they overpaid is because they used a valuation model that values the stock over the next 10 years instead of over the next 5 years. And if you value it over the next 10 years, the number is going to be very high, but this would leave you with a very high margin of overpaying. But if you only stick with something like a double every 3 to 5 years, most of my stocks actually double, way before 5 years. Sometimes 2 years, sometimes 3 years, sometimes I sell them before. But this is the standard I stick on, and it gives me a very hard time to actually overpay, because I know that if I'm paying above a specific price, I'm not going to get this double. So this was my kind of video for today. I do much more of those in-depth analysis videos in my own investment group if you're interested in joining. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.